Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 4th of February 2021, and we're reporting that gold today has fallen below that crucial $1,800 mark and ask the question, why? And hopefully answer it too. So let's take a look. Now, earlier today we produced a video entitled, Why the Silver Short Squeeze is Over, but Premiums Will Remain High, where we pointed out that if a short squeeze actually did occur at all in the first place, some are arguing it hasn't, though we did see a pretty good rise, it has since failed, and that silver will probably revert back to the level it was at the middle of last week before the inverted commas squeeze took place. Now, our attention this evening is directed towards gold, which at the time of writing is 7 p.m. GMT, and gold is $1,789, some $58 lower than Friday's close, and below that crucial support level of 1,800. And we have to take a look as to why this has occurred. Well, firstly, the attempted Redditt Robbin Hood silver squeeze certainly helped gold, even though most of the attention was on silver. We even saw bullion dealers admitting that demand for gold coins had risen dramatically, not perhaps as largely as silver coins, but on the back of that, precious metals were in demand. Though we have to admit, the advance of gold was only some $30. Rising to 1,877 and have since now fallen back. We do think that gold will toy with this 1,800 level, and we'll talk about that a little bit later on. So let's take a look at some of the influences on the gold price. In other words, what's caused it to fall below that crucial level? Well, firstly, the US dollar has strengthened, with the spot index rising from last Friday's close of 90.58 to its current 91.54, almost up a full point. Secondly, some of the economic data announced this week has been broadly positive, with 2 out of the 3 job reports, with the third one due tomorrow, showing an improved situation. With, as mentioned, the major non-farm payrolls coming out tomorrow, which could potentially have the largest effect. The ADP report published yesterday showed an improving figure for January from minus 78,000 jobs in December to a positive 174,000 last month. The initial weekly jobless claims fell from 812,000 to 779,000, while the continuing jobless claims figures also fell from 4.79 million to 4.59 million. In addition to these 2 job reports, the market services and ISM services PMIs have also shown improving figures. Now, the potential effect this data has had and will have is downward pressure on the proposed Biden bill, making it more difficult to argue for a full $1.9 trillion stimulus, which markets to some extent have generally factored in, with most of the American exchanges currently up around 0.8%. But there are international developments too that have played a part. The Bank of England in the United Kingdom issued a statement to banks telling them that whilst it did not expect to move into negative interest rate territory, they should prepare for it. In fact, Bloomberg reported earlier today, we'll just quote a small excerpt, the Bank of England told banks to start getting ready for negative interest rates, while saying that message shouldn't be taken as a signal that the policy is imminent. The central bank's Prudential Regulation Authority said most financial institutions aren't sufficiently prepared, especially as regards to retail products like rate-tracking mortgages, so they should take at least 6 months to set their systems up without running undue risks. The Bank of England made the announcement as it held its key rate at a record low of 0.1%. The move raises the threat that the central bank will push borrowing costs below zero, turning the lending business on its head by charging depositors to store cash while giving money back to borrowers. The Bank of England has been studying the case for negative rates for almost a year as a way to pull the UK out of its worst slump in 3 centuries. So far, it hasn't followed counterparts in Europe and Japan in implementing the policy. I don't think the bank would be making a statement like this if it wasn't seriously considering using it, said Nigel Terrington, who runs Paragon Banking Group plc, a lender to residential landlords. Many banks said their retail banking systems were not built to accommodate a negative bank rate, and substantive changes would be needed to be made. Sam Woods, who heads the PRA, said in a letter to financial executives that was released Thursday. He didn't specify any banks by name. Unquote. So we can see that if the UK falls into negative interest rate territory, then this is going to undermine sterling vis-a-vis the dollar. There are other issues as far as the euro is concerned, but we shall cover that in another video. So, earlier today, we saw US Treasury yields continuing to climb as investors watched for progress on the economic relief plan and also following the already mentioned better than expected private jobs data published yesterday. The yield for those interested on the benchmark 10-year Treasury note rose to 1.139%. That was early this morning, GMT, while the yield on the 30-year Treasury bond advanced to 1.927%. So with all these factors combined, this has caused gold to fall back. In fact, it was quite interesting to read Christopher Lewis of FX Empire, who published a couple of hours ago, quote, "Gold markets have broken down significantly during the trading session on Thursday to slice through the 200-day EMA like it was not even there. Ultimately, the market looks as if it's going to try to reach down towards the 1767 level. That was the scene of a major hammer that has turned things back around, but ultimately, I believe that the support probably extends down to the 1750 level, which is the level we've quoted. If we were to break down below there, then gold will be in serious trouble for a longer term downward move. Until then, I have to assume that there is probably going to be some type of recovery, but we certainly do not see it yet," unquote. Now, it's too early to write off gold recovering quickly or collapsing, but we do suspect that if the non-farm payrolls are better than anticipated, then we could see gold fall to our 1750 trading range. I may even attempt, if not tomorrow, then earlier next week, to hit our outlier range of 1700 level. Frankly, though, the figures would have to be really very, very good for that to happen, and Biden's stimulus plan in very serious jeopardy of not being fulfilled. So our suspicion for the moment is that gold will flirt just above, or more likely just below, $1,800 until more solid reporting is announced. But we must not rule out that potential downward trajectory. And if any further comment is made vis-a Biden's plan. Now, silver, for interest, has fallen further from this morning's $26.44 to below the $26 we predicted earlier, or forecasted, actually dipping as low as $25.84, though now it has recovered slightly and stands at $26.28. Again, we're really expecting, if we were to put our hand on our hearts, to see silver at this moment flirt around the 26 to 26.50 level. Again, until more news is heard. That's it for now. Do share your thoughts about what we've covered. Do you see gold going down to 1750 and then 1700? Or could you even see it going even lower? What about silver? Is that going to fall equally? Is Biden going to get his stimulus plans through? And is the dollar actually going to strengthen further when you consider only last week we were all anticipating further declines? Do share your thoughts. Meanwhile, thank you so much for listening, and if you haven't already done so, please subscribe to the channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.